Okay, here we are, August 24th, about 3:30 in the afternoon. Going to get going here with workshop session number 3. What we're going to be talking about today is order flow. We're going to break down the order flow today. We're going to start to break it down between today and tomorrow. Look at, first of all, talk a little bit about concept. Explain exactly what's going on in this inventory transition area is very important to understand. Seeing the market pop up here to the next zone. And remember, this was the major level. This was the minor level here. Definitely a time of the day that we would really be thinking twice about even trading. But what we're actually going to be doing, not this coming week. This coming week we're going to finish up Workshop D. But then the following week, I think we're going to push off the start of the next workshop session for a couple days till that midweek. And then actually Monday and Tuesday, maybe alter the hours of the live trading a little bit, take a break during the mid-afternoon, and then come back together later in the afternoon, 3 o'clock, and see if we can't trade the late afternoon a little bit and kind of switch it up and show you how we handle the situations that occur late in the afternoon as well. Seeing this late day push and basically, bigger picture, late day short squeeze, right? These guys seem to be nervous about holding on into the close, and they're getting pressured and they're starting to dump out a little bit. So let's update our zones here a little bit. And obviously this supply zone was taken out, so we're going to erase that. Going to erase that imbalance. What we could do here is actually merge these two areas, right? Overlapping, and then we'll get one nice symmetrical area in here. Right click, merge with prior profile. Now we have a nice area there that we could deem as a value area, wholesale value. You could actually go in here and split this out, take a look at what this looks like. You have a little piece of value here, but what we're going to do here to bring our attention to this area is just going to highlight this imbalance here that's taking place. Okay, we're getting into this supply area. We're going to take that out of there. But you see the market reacting up in our next zone up here. All right, not quite at a level of true inventory transition, but in the neighborhood. And we know we have this level right above us, so we'd be able to start working shorts coming into the bottom of this zone, right? We know odds are we're going to get this little downtick. Is this going to be the absolute swing high? Well, we don't know that yet, but the opportunity is there for us to start doing business to the short side. Now we're going to get into the order flow in just a second, and I don't know what it is. My head is still a little weird from yesterday. I don't know how to explain it, but I still feel like I have the some type of equilibrium issue in my head from yesterday. It's strange. It really is. But it's still there. I still have that, not like a full-blown queasiness, but definitely a little bit of queasiness. Just not feeling myself. Hope that doesn't mean that the Earth's axis is totally off whack here now or something. But okay, let's update this over here. All right, good stuff, Shiva. Good to know. And where is that autosave function located? Global general. Okay, cool. Global settings, general settings, autosave chart books, autosave time and minutes. I mean, you could even. How often did you have that set to, Shiva? I'm thinking like maybe once every 6 hours or something. Yeah, every 30 minutes. Let me put it for once every 2 hours. That's plenty. What's 3 hours? 180 minutes. Let me put 180 minutes. Okay, good stuff. Good to know. Not the end of the world if you know you're getting your data saved every 3 hours, every 6 hours. The most you're gonna lose is just a couple zones that you updated. Now, are there any questions on zones, guys? Anything that we went over yesterday and the day before? We put those notes up on the site under the toolbox, the notes for session one, which really, apply to session one and session two. Any questions on the three main pieces of information we gain from looking at the profile charts? Number one, the zones themselves. Number two, areas of more obvious imbalance. And number three, just taking in and making note of acceptance and rejection in the market. I'm not going to spend a lot of time reviewing that today. But if anybody has any questions, we basically review that every day throughout the day on a real-time basis. Any questions about anything specifically from today, any of today's trading? There were some good setups today. There was a bunch of setups we didn't take. This morning was rather slow. The market was just got into that one-way type of push. And, if we can come out of a move like that where it's really moving steadily in one direction and just hitting stops, if we can come out of that unscathed and even a little bit ahead of the game like we did, you can't ask for much more than that, guys. That type of one-way action day, number one, doesn't happen all too often. Usually maybe 20% of the time do we get a day like that. And it wasn't even a day. It was just a move, right? Just for a couple hours, and then it started rotating the other way. So, on a day like that, which is just steadily moving in one direction, hitting stops, not the most ideal day for us. It doesn't have to be a losing day, but if the market continues in that direction, not the most ideal type of day for the conditions that we look for trading. On the other hand, rotational type of days are the best type of days. The markets that are rotating back and forth and continuously throughout the day having these little minor inventory transitions, those are ideal. But you see a broad mix of days here, and we're able to consistently trade on any day. We just have to be willing to adapt, and as traders, of course, everything that we're doing, we're constantly in this condition, this mode of adapting. Seeing a little late day push here. This is the current level that I put on here. It's going to be interesting to see this inventory transition here. Let's see where the next level is. not too far above right here. Now, these guys are taking heat, right? That's why they're getting nervous. They're starting to bail. But these guys here are taking even more heat, you know? So let's see how these guys react into the close. Now, we're going to start breaking down the order flow today, guys. And I don't think it's going to be a super long session today because I'm definitely, I definitely feel out of it. My head is just feeling a little out of sorts. But let's get into some concept about order flow. Let's talk about the basics. Very important to understand what's occurring in the market. And I'm just going to get rid of this. We're not trading anymore. The day is done. It's important to think about the market in terms of fractals. And we've talked about this before with the zones, how we think about the market and in terms of the same patterns and conditionings actually happening on every time frame, whether it's below the time frame we're trading on, way above the time frame, the same patterns are occurring. And that's what we mean when we say the market is fractal. So what we do is essentially we're breaking down the market into upward and downward swings, rotations we call them. And that's what we mean when we say rotating or rotations or the market's rotating. The market is rotating either in one direction, in the opposite direction, or maybe rotating back and forth. Same as if we say the market is stopping the uptrend and transitioning into a downtrend, or stopping the up auction, transitioning into a down auction. Simplest terms, these are swings in the market, right? And within every swing, there are tons of little swings, right? So we can look at the market as this one big swing, but then as we look further in, we see a lot of little swings within this big swing, and this is what we mean about the markets being fractal. Now, important to look at the market in terms of these swings and thinking about how whether a particular move amounts to just a few points or just a few ticks. Every move in the market consists of numerous and buying and selling waves that are coming into the market, right? So this is a buying wave right up here, but within this buying wave, it's consistent of numerous buying waves that are within this bigger wave. Each one of these little waves and this bigger wave, they all have a certain duration, right? They're only going to run a certain amount of distance. They run just as long as they can attract a following in that direction. And that following, in terms of an up move, is called demand. Most of the demand coming into the market is shorts getting stopped out. Shorts saying that they don't want to be in the market anymore, so they're buying at the market to get out of the market. So when the stops get exhausted in one particular direction, when all the losing traders have bailed, the move is exhausted for the time being. That's the spot we look to take advantage and get into the market and trade that rotation in the other direction, right? We're not predicting, we're not ever saying this is going to be the swing high for the day or the week or the month or anything like that. All we're trading on is the probability that this is going to be a condition and is coming into a location that's going to provide us with a high degree of probability of a rotation occurring in the opposite direction. That's what we're looking for, those rotations, a reaction, if you will, in the market. Now, when this move gets exhausted, for the time being, this wave ends in this direction, and what happens? A contrary wave comes in the other direction. right? And the same thing plays out all over again. This move goes as long as there is a following, as long as there is supply coming in the market. Supply dries up, demand steps back in, and then what do? They head the other way. Okay, this is actually a good example on this wave right here. This wave heads this way until what happens, guys? These guys just got stopped out, right? This move popped up for the order flow to come up and take these guys out. And as soon as these guys are taken out of the market, no more demand in that direction. What happens? Now you get your contrary wave. Your contrary wave goes how far? Far enough to get all of these longs out. Right? So what we're trying to do is read the market and read the order flow so we can identify the points where fear will manifest itself before the triggering of stops will occur. Right? And when we get to that point where we're able to visually identify that and logically identify it, then you can trade confidently knowing that you're trading with an edge. And, that's just part of our edge, but that's a big part of the edge. Looking at the order flow and understanding, okay, maybe a stop run, maybe stops aren't done getting hit right here. Maybe we didn't come to an inventory transition level just yet right here. But yet I know it's within a stone's throw. I know we're coming up into a zone. I know that I have divergence, so I know that I could start looking for a short trade if I like. If I'm feeling like I want to start to probe a little bit to the short side, even though I know, hey, you know what, we didn't have a true inventory transition, a thorough inventory transition on a higher time frame, but yet we're almost there, and I know that I can lean on this level. Does that make sense, guys? It's if anything, you can think about it, maybe, are we getting in a little bit early? Yeah. I mean, it's not a textbook trade because the inventory transition didn't actually take place yet, but yet we know in the context, we know where that level is. We know where we stand. We know where we are on the market map, on the playing field, so we're aware of it. Flip side of that is if you want to wait for those textbook setups, that's perfectly okay too. Perfectly okay. You see these inventory transitions occur every day. You could wait for them if you'd like. And we're going to get further into the trade setups and putting that all together. We're not really worried about that just yet. But here's another interesting point, guys. And there's a couple of really interesting points we're going to talk about today. And I'm going to summarize these in a little a notes outline and then kind of put that on the site for everybody tonight or tomorrow as well. But think about this. Since most traders have a large portion of losing trades as their results over time, in other words, we know that, what's the ratio? 90%, 95% of traders are losing traders. So those losing traders, most of their trades are losing trades. So it follows that a lot of what's causing a price change in the market, a lot of what's causing a wave, must be losing trades being liquidated. Right? In fact, about 80 to 90% of price action in the market is simply losers liquidating their losing trades. And as soon as that energy, as soon as that action of those losing traders comes to an end, there's no more losers to get out of their trades. In other words, here, there's no more demand coming into the market. Yeah, we'll have some retail traders sprinkled in here getting long. Horrible trade location, but for the most part, once that demand trickles down and diminishes, the market moves in the opposite direction. So it almost gets to the point where when we begin our trading day, or when we're looking to get into a trade, before we place a trade, we can ask ourselves this question: where is the loser? Where is he going to be crying uncle? You don't really need to answer the question which price is coming next. It's more a matter of where and when will the loser quit, right? And that's what these levels are all about. Okay, and this is the areas in the market where we expect that temporary vacuum to come in the market. And we say temporary because we don't know if it's going to be the top here. We're not trading based on that. That's not important to us. I don't care what the market does a half hour after we're in and out of the market, you know? But what we are concerned with and what we are looking for is that vacuum that's going to come into the market, that temporary vacuum. When we say temporary, because we know at least it's going to be temporary. We don't know if it's going to be a permanent situation. We don't know how far the market's going to travel in the opposite direction. But we do know with a certain probability that we can expect that vacuum at that point. That's what we're trading on, that temporary vacuum that comes into the market. And it took me a long time of trading and losing and getting stopped out continuously to realize the importance of all this. When you look back over your losing trades, which were stopped out, and see how price reacted after, a lot of times they would have a tendency to continue to go in the direction that you thought they were going to go in, but without you because you were stopped out. And the end result is you wind up closing out a lot of losing positions rather than capitalizing on the market moves. And this is what it comes down to. Getting in as the losing traders are getting stopped out, or if you're already in, realize what's happening. Realize, hey, you know what? The market's moving against me a little bit here. Perfectly fine, because I know as soon as these stops are done getting hit, it's a high degree of probability the market's going to turn around. Big difference trading with that information. So the business of trading, a lot of it comes down to identifying these areas where a significant number of traders are going to feel compelled to take action, and then entering based on that information. As they're taking action to get out of the market, we're getting in to take the other side of the trade. And if you can achieve this on a consistent basis, which each one of you will be able to achieve, then you've got yourself an edge. We're not prescribed to the school of conventional thinking because we're not interested in conventional results. Especially since conventional results in this business of trading equates to losing money on a consistent basis. Instead, we're interested in and we prescribe to the school of reality-based thinking. But we're not trading based on what we think our reality is, or trying to force our reality onto the market. What we're trading on is based on the reality of the market, supply and demand. And in trading, those who view the markets through the eyes of reality simply get paid from those who don't. It's a massive transfer of accounts, never-ending transfer of accounts, from those 90% or 95% losers over to the 5% or 10% of winners consistently. And again, your goal is not to be a clone of me. You're not going to take every single trade that I take, and you're going to take some trades that I don't take. But your goal is to trade the markets through this lens of order flow. And you see how it's possible to trade consistently on a regular basis. And, very important, and control your risk. And a little side note, some of you haven't even been in here long enough to see me have a losing day. We have losing days every once in a while. So when I say by controlling risk, I don't mean to say we don't have losing days or we don't have losing trades, because we do. But we control our risk, and if we have a losing trade or a losing day, it's not going to be one that's going to, ding us or hurt us or put us out of business, worst case scenario. And believe me, there was a lot of traders 2 weeks ago, 3 weeks ago, when the market started to move as tensely as it did, that literally got put out of business. I told the story, there's a few new guys in here, so I'll tell it again, but I talked to a trader acquaintance of mine who I know earlier in the year had built up approximately 500 to 600,000 in profit, something like that, up till about maybe May or June. Kind of treaded water in July, and then in August he wound up that week period where the volatility really expanded. He wound up giving it all back and more. Everything he'd made for the whole year up to that point, he gave back and more. That there's just, it's ridiculous. There's no excuse for that, you know. And he obviously had some sort of edge because he was able to trade consistently and make that money, but yet he wasn't able to control his risk, and he gave it all back. It's a very important part of the picture. There's the cash close, guys. See this last minute push up here? These guys just, for the most part, all just got stopped out. And that was it. No more demand. This zone actually contained the market, and now you got that demand vacuum coming in here. So guys, the opportunity we're looking for is when that supply-demand relationship is out of balance, you know. And what is that supply and demand relationship? What it comes down to is human beings reacting to the market, buying and selling, right? And that's what we're tracking here, and that alone ultimately determines price. And when we look at them from that perspective of that ongoing supply-demand relationships, and you see that identifying good trading opportunities, it's not that difficult a task. But it's not logical to someone thinking about the market in terms of basic human emotions and basic human intuition. The human mind is not wired to trade properly. Our decision-making process is not ideally suited for trading successfully. And it's almost like you have to think, 180 degrees opposite to what your normal intuition would be as a newbie trader to be successful. Once you adjust your reality, then your intuition becomes in sync with the market. But most people just can't focus on reality, or they don't focus on the market reality when they decide to take action. Their decisions are based on emotion. I know everybody's been there. I've been there. But here's one thing for sure. If you want a consistently profitable trading strategy, you better make sure that the person on the other side of your trades is a consistently losing trader. And if our strategies aren't based on taking the opposite side of the losing trader, then guess what? We're going to be the losing trader. We don't need to know the exact person on the other side of our trade, but we do need to know that we're getting into the market in an area where odds are we're taking the opposite side of a consistently losing trader. And the order flow information gives us that information. In case you guys haven't realized this by now, and I know everybody here has, this is our mantra basically. Everything that happens in the market is a direct result of order flow. Change in order flow precedes change in price. And again, these things are going to be in the notes, and I don't know how many of you guys are into stickies or writing notes on a bulletin board, but there's certain things that you should have in front of you at all times as you're learning, so you could really ingrain this stuff and absorb it and resonate with it. But knowing this, it makes sense that we have these tools in our trading arsenal that enable us to gauge the true supply and demand. And I'm talking about these tools here. And I'm putting in another chart into the members section that defines our order flow dashboard here. And just so we're all on the same terms, if you have a question about the buy-sell pressure here, say, the order flow on chart 2 or the buy pressure sell pressure on chart 2. This is chart 2. Chart 1, chart 2, chart 3 on our order flow dashboard. These are our tools to analyze the real-time order flow and the order flow, the supply and demand that took part in the past. But this real-time order flow analysis, it clearly displays the conviction in the order flow and who's in control at any moment, buyers or sellers. Right? So the way that I see it and what we're doing here, what do these studies actually do? What are they measuring? Well, what they're measuring is the difference between the buyers and the sellers of the market who are using market orders. Okay, so these are the traders who are trying to get into the market right now. Right, so if someone wants to buy the market right now and they're aggressive, they want to get executed right now. They don't want to take a chance on working a limit order. What are they going to do? They're going to buy the offer. All right, so right now they're buying 3/4. And that's what happens when a stop gets hit. When a stop gets hit, it turns into a market order. So that market order winds up buying the ask. If you're aggressively selling here, you want to be short or you want to get out of your long trade, so you go into the market, you're hitting the bid. You're hitting 3/4 right now. So what we're doing in the order flow is measuring the difference between buyers and sellers using market orders. And these are the traders that are trying to get in the market right now. It's important for them to get their order into the market right now. Using a market order trade versus clicking on a certain price level with a limit order and waiting for price to come to their exact level and get filled. Right? And that shows that the people getting into the market with market orders, they tend to have more conviction. And that conviction could be because they're bailing on positions, so they're capitulating and covering. Or they could be initiating new positions. Or they could be taking profit. But the end result is that they're buying at the market. They're aggressive. They want to get filled. They want to make sure their order is filled. So the order flow studies that we use count the order flow of those getting in and out of the market at the bid and ask with market orders. Does that make sense to everybody? In the case of this study specifically, it's like a real-time open interest where every time trades go off on the offer, this is going to go up, right? Because that means people are buying the offer. So if we have a 4-lot go off at 75.50 right now on the offer, this number here is going to go from 928 to 932. If we get a seller right now that sells 75.25, this number is going to go down. Let's say we had a 100-lot go off right now. That would go down to 81,668. This is a running total of contracts that are going off on the offer and going off on the bid. With this study, it's more of a smoothing study that smooths the action that's taken place over the last number of bars. 14, I think, is what this is set to. So it's more of a buy pressure, sell pressure. It's not a cumulative study. This is cumulative. It keeps adding from the point that you start to bring data in until now. It keeps adding and subtracting. It's cumulative. This always goes back and forth above the zero line. So it's only looking back at the last 14 bars, the last 14 periods of order flow. It has nothing to do with price, but it's calculating the pressure to the buy side and the sell side, and it's showing us, is it dissipating in one direction and growing in another, or what exactly is going on with the momentum of the order flow, if you will. You know, there's different ways to look at order flow. There's a lot of different studies out there. People look at time and sales. People look at the dome. I've never found an edge with any of that stuff, and I've found this is the information I need to see, the buy pressure, sell pressure in combination with the cumulative delta. And I don't really need to see footprint charts. I don't want to do math. I just want to keep everything very visual. Now, a couple different things that we're looking at here. Number one, divergence. Let's talk about divergence in the buy pressure, sell pressure. Pretty easy. When the market is showing divergence, in other words, price is making a higher high, and the buy pressure on order flow is making a lower high, well, quite simply, that's telling us that the buy pressure is disseminating. Right? And the way we can see this visually is to compare the angle between that and that. Anytime there's a difference in that angle is a divergence. Even if price made almost an equal high and order flow was just a little bit lower, that's still a divergence, right? This is a pretty obvious divergence here, guys. Here and here, what just occurred. This is textbook, this is obvious, but sometimes it's not so obvious. Sometimes it's just subtle. But it's still a divergence, and it still is showing us that the buy pressure is diminishing. Does everybody understand divergence? How it's just showing us the difference of magnitude between price and order flow? Okay. Now, we also look at divergence in our inventory. When we have a divergence over here, in other words, price making a higher high, like right now, you could say this is a subtle divergence in here on these two levels, right? Let's draw a trend line on here. You see the angle there, you see the angle here, and if you compare those two angles, you see that this angle has a greater slope to the upside than this does. Divergence. Okay, and we have divergence in the cumulative order flow, and we just call this inventory for short. When I say inventory, we're looking at the inventory levels. We're referring to either this one on the higher time frame or the shorter time frame. This is the same exact study. It's just that this is the foreground, FG is foreground, shorter time frame, BG is background, longer time frame. So this divergence, when we have it, essentially what we're doing is measuring the conviction of the smart money traders as price comes back in their face. Right? Are they holding their positions? Are they adding to their positions, or are they bailing in their positions? Since it's their footprints that we're trying to follow, the smart money, this information is of supreme importance to us. We saw a really good trade today on the shorter time frame this morning. And I took a screenshot of this. We're going to put that up on the site as well. We're gonna, I have a bunch of screenshots already, but this is divergence. This is showing us a commitment of short traders here. How do we know this is smart money? Well, retail traders don't have the wherewithal to create divergence in the order flow. They don't have the power in their account as far as account size, and they're always collectively doing the wrong thing at the wrong time, or I guess doing the wrong thing at the wrong time. When we see divergence, we know it's smart money being active there. Now, are they always going to be right? No. The market could still go higher from here, but at least it tells us that they're trying to get short here. And then by looking at this order flow this morning, we can say, hey, you know what? That's happening in the face of this longer term divergence here. Right? This was right here. right? You see the divergence there. Actually, it's even greater, right? Price made a higher high this morning at 10 o'clock or 10:30, and yet order flow didn't. So what is that telling us? That, well, short the shorts, the smart money short traders are staying committed here on the higher time frame. That's the background. And on the foreground, this is the first time, and I made note of that. This is the first time that we really noticed that to such a big degree here. Once the market opened, that shorts were starting to stay committed. So now we have the smart money here on the smaller time frame staying committed with the background of smart money staying committed to the short side. Does that make sense, everybody? How that, when you can begin to notice that, how that's going to really guide you and help you with your confidence, say, oh yeah, this market looks pretty intense here. It's really rallying. I don't know if I want to get in the front of that. I don't know if I want to step in front of that. Yeah, of course not. But when we start to see clues like this in the face of longer time frame background traders staying short, with the market coming up into a zone or close to a zone, hey, that's important information. With, let's take another one, another step, another level of confirmation with some nice divergence. Wow, what was that? My screen just went green here, guys. You see a green screen here? Yeah, that's weird. That just happened. Alright, hold on one second, guys. I'm gonna pause it here. Something interfered there. But these are the clues that we're putting together. And again, guys, I don't expect you to put it all together right now. I really want you just to concentrate on certain elements of the dashboard. And then as time goes on, you're going to see me and hear me talk about these things, and then the synergy is going to start to come together. And I'll be continuously just pointing these situations out throughout the day. And after hearing it a certain amount of times, after seeing it over and over again, after learning about it today, tomorrow, we'll talk about it next week, and then a new workshop session will start the following week. You can take the classes again, you have the videos. After all that conditioning, it's going to become second nature to you guys. Everybody is going to get it at a different speed, a different level. That's fine. Sometimes it's a matter of hearing me say it a certain amount of times before it clicks. But what's going to happen is you're going to have these aha moments where things are really going to become clear. So that's divergence. Okay, and by following the divergence and order flow in general, we're paying attention to the actions of both the strong hands and the weak hands in the market. At the inventory transitions, we know what's happening there. The weak guys are getting stopped out. And when we have divergence, we know what's happening there. The strong hands are staying committed to their positions. But that leads us to our goal of trading in concert with the stronger market players. Those clues help us. Are we net long or net short at the high? When the market's making a new high, we could say, hey, you know what, we're net short up here. We have divergence. These guys are staying short. They're holding on to their positions. And you start to realize that knowing the key zones to initiate trades from and being able to use the order flow for confirmation to help with timing, that's empowering, guys. Truly empowering. Having a surefire way to empower yourself and improve your peace of mind trading the markets by utilizing a methodology that makes logical sense We're not basing this on any wacky indicators that people look at and use. This is logical, objective, data-driven sense. And that's what our approach is all about. And I've found order flow and cumulative delta and divergence and buy pressure, sell pressure, all of this collectively called order flow. I've found it to be a very highly effective way to gauge supply and demand pressure in the market. There's just useful, critical information to be gained by monitoring the order flow at these key price levels and in certain contexts. But we don't become mechanical traders. What we're doing, it allows us to look inside a normal bar and form a logical conclusion on what's occurring. Losers capitulate or winners taking profit, new trades being initiated. But it's not a system that we're going to use to mechanically trade the market with hard and fast rules. It's not something that's going to show us exact turning points. A lot of times, it will. But we're not depending on that. We don't need to depend on that. We don't need to depend on being able to call exact tops and bottoms, I guess is what I'm trying to say. There's nothing out there that's going to show anybody that. But that's what traders are looking for. Instead, we take notice of the context of the market. We take notice of the order flow, where our zones are. And we're adaptable to changing conditions. It's so important. I try to stress that continuously too. Realize this, because we're showing a divergence or we're showing a commitment at a certain time when the market is hitting a zone. That could change a minute from now. There could be a divergence at a high. There could be no demand there. And then all of a sudden, some trader in China decides he wants to buy 500 contracts. Guess what? Now there's demand again. And the picture changes. So we have to be adaptable. We're trading based on what we're looking at that time. So our goal is, yes, to identify the high probability, low risk price zones ahead of time and know what we want to see happen in the order flow at that time when the market gets there to take a trade. But we also have to be willing to change our mind at the last minute if the market tells us something different and adapt to changing order flow conditions. Last minute meaning, hey, maybe we don't put on a trade because we could have three things saying, hey, you know what, this is a good trade, but one important thing saying, hey, you know what, just wait for a little bit more information. And a lot of times you'll see me, I'll have one or two things lining up, but yet something isn't right, something isn't absolutely textbook in that certain situation, and because of that one thing that's not right, or that one thing could be so drastically bent in the other direction that it's enough to take me or keep me out of that trade. So we have to be willing to change our mind and adapt, either before the trade or even once we get into the trade. You see me many times get into a trade, and 2 seconds later I'll immediately start taking inventory, or if not get to flat, if something happens in the market that I'm not comfortable with. And it doesn't mean the market can't turn around and do what I originally thought it was going to do, but yet what I'm seeing right then and there in the order flow is telling me that I'm better off just getting out and reevaluating. Very important. Now, the other piece, that's divergence here. The other important piece of information that we're getting from this chart is the inventory transition events. Right? We use the cumulative order flow specifically so we can track the inventory, right? So we can index where these zones of inventory are held from. you always want to know where these traders are holding their resting inventory, and be aware of what they're doing as price trades back into these levels of resting inventory. Very important to take note of these order flow transitions. And what exactly is the inventory transition? Well, it's when a large group of inventory gets neutralized, right? They get taken out. There's a transition. The inventory goes from the weak hands to the strong hands, right? For example, as the market is selling off into an area of previous held inventory, sellers, commercials, traders that are holding inventory from higher price levels force the market down, right? They want to hit these stops in here. They force the market down into these stops of long so they could take profit, right? They use the resting long inventory to exit their positions, right? So the smart money sellers in this case, they're driving price down to the point where they can cover out into the stops that are going to start to get hit here, right? Because we're talking about smart money, they have positions that dwarf the size of our positions. Our positions are nothing, but when you have hundreds of thousands of contracts on, not hundreds of thousands, but hundreds or thousands of contracts on, you need liquidity to get out of those positions, right? You can't just throw 1,000 lot up in the market and don't think that you're not going to affect the market. You're going to get slippage, right? So if they're short and they need to buy, if they're short 1,000, 2,000, 5,000 contracts and they need to buy those contracts back, they want to do it as a bunch of longs are getting stopped out and selling their contracts, right? Now think about that. As longs are selling supply, shorts from above need this supply to buy from to cover their winning trades without driving price against themselves. So they need that liquidity. That's their goal in hitting stops. It's not personal. They don't know whose stop is there. They just know where the inventory is. And as those stops start to get hit, they're going to take profit on their profitable short trades from above. Does that make sense? I know it's a little, it's not easy to grasp the first time. You got to really think about it and hear me talk about it some more. But what it comes down to, the market is constantly trading back and forth between zones of this resting inventory. Short smart money traders selling and driving price lower to the point where they can cover out into capitulating long traders, right? Long inventory. Smart money long traders, as of right now, closed today, tried to drive price up to squeeze out short traders. Right? What do short traders have to do in here to get out of their position? They have to buy. Right? So what do long traders who got long in here today and yesterday, what do they need in order to get out of their position? Well, they need to sell, so they need people that are willing to buy. Because if you want to sell and there's no one around to buy, you're going to drive price down against yourself as you sell your contracts. So these commercial traders, these participants in the market, they're continually just driving the market back and forth. Just like our example earlier with all these little inventory situations. This is happening on all levels. On this level, who is it? Well, it's the market makers. It's the floor traders. They're going to drive the market back and forth to hit stops to take profit. right? If they're short up here, what do they need to do? They need to drive price down to get these guys that got long in here to get out of the market. And as they're getting out, as they're selling, these guys have that inventory so they can buy to get flat. So these commercials, and when I say commercials, smart money is synonymous with the floor traders, the market makers, depending on the time frame we're talking about. But these smart money traders continually just driving the market back and forth as they use these retailers' inventory for their exits, right? The retailers, the retail traders, they're turned into the weak hand. When prices are driven back to these pricing levels where they first put their trade on or beyond that level, they get turned into weak hand. They're taking heat. They got to cry uncle. Does that make sense to everybody? Well, we're going to talk more about the cash market in session 5, which is going to be on Monday. But the cash market, the equities market, really drives the futures market for the most part. And they're constantly pushing the market into areas where they could hit those stops, depending on what they need to do with their inventory of equities. Think about all those huge institutions and traders that are trading, hundreds of thousands of shares of stock at a clip. They need to hedge their positions with futures. So, we don't really need to think about it on too deep of a level like that because it could get confusing at a certain point, and there's no need to. But from a basic standpoint, we need to know that the equities market is really the dog that wags the tail, and the tail is the futures market. And there's very few times throughout the day that the futures market will lead the equities market. One of the only few times during the day is when there's a major inventory event occurring, a major inventory transition, and there's no more demand in a certain area. The futures drops, and then that can influence equities temporarily until equity starts to take the lead again. But equities are for the majority of the time, they're pushing futures around. And that's why you'll hear me say quite often, the equities market seems to have an agenda here. And we see these battles all the time where the futures traders will try and stay committed at a certain level, and the equities traders keep pushing with the buy programs, and yet the futures traders trying to stay short, and then boom, finally they get them to pop. Like yesterday, there was an instance yesterday where there was a battle going on, and they just kept pressuring the buy side. Futures price kept going higher, and yet that inventory was trying to stay short. And then all of a sudden, boom! We talked about it as it was happening yesterday. I said this thing looks like it's going to pop, and that's when you see that gap, because that pressure is just like it pops, and all those guys that are short there, they want to get out because they see the pressure coming in, they can't hold anymore, and they all capitulate at the same time. Excuse me. And these smart money traders, commercial traders, we call them smart money because they're doing the smart thing, but it's not rocket science what they're doing here. It's not like they're a bunch of brainiacs in what they're doing in their activities. It's almost like they're the mob, using their power and their liquidity to operate on their own turf to extract income from other people's weakness. And that's why knowing these levels of where the commercials will put the hurt on the weaker hands, it's powerful information. And there's a couple of signatures that are occurring within the order flow. And we're going to get more into this tomorrow in part 2, but we're going to break it down with some screenshots and really make it crystal clear what's going on here. Excuse me. I'll describe it briefly here, but we're going to break it down tomorrow. And I'm not even going to put this in the notes because I don't want to throw too much at you. I just want you guys to resonate on this tonight. You know, how the market moves to a certain point of inventory, why it's moving in that direction, why the smart money wants to, if they're long, they want to push the market up to force shorts out because they need that liquidity to get out of their position without driving the price against themselves. But the combination of signature activity within every swing high and swing low and every type of inventory transition that's occurring on every time frame. Excuse me, guys. Three signatures. Number one, capitulation. As the market's moving closer to that level of inventory, keeping the pressure on in one direction becomes more intense. At the end, you get that capitulation of the collective capitulation of shorts throwing in the towel. Right? We had that right here. It happened. Capitulation. This is when a mass of resting inventory is bailing out of the market to go flat. The losers turn into weaker hands and bailing out of the market. And they're doing that with market orders. Right? And that's why it's showing up in here. Market orders when the stops get hit, and market orders when they need to get out. This market, look at this market moving pretty intensely to the upside. If you're in here short from in here or whenever, you're taking heat, you want to get out. It's hard for these guys to wait for a downtick because they're taking so much heat. They just want to get out, right? And you see, there really isn't much of a downtick here. That's because they keep. It's like they're driving price against themselves. You know, all the losers are fighting here to get out, and they're actually hurting the other losers because they're buying to get out. Now they're driving price further against other shorts. So that's step one, losers capitulating. In fact, let's bring this over real quick here and give you a good little visual of capitulation here. Let me switch something here first. Good example right here, guys. Right about 4 o'clock here, right? These are contracts going on the buy side, contracts going on the sell side. So these are contracts going off on the offer, contracts going off on the bid. Look at the markets pushing, pushing, pushing. Finally, right before the cash close, all these guys together decided that it was time to get out. They couldn't hold anymore. Right, we saw a little bit right here. All right, you see this capitulation right here? Now demand already, you can see demand dying, right? It's not switching off, but now you see how demand died up here. It didn't totally die, but it diminished by half. Now look at it. Now totally dead up here. Right? So that's step one, capitulation. Now comes the cash close, 15:48, getting close to 4 o'clock. Now think about who's taking heat here, and there still was an element of short inventory still holding on, seeing if they can get price improvement here before they get out of their trade. Boom. There you go, right here. You think that this was a bunch of smart money coming in here at the high of the day saying, hey, you know what, I need to be long here right at the close at the high of the day. No, of course not. This is losers capitulating. Who else is buying at the high here? These guys here getting out of their losing trades. We're going to look more at this tomorrow and break down the 3 steps and show you some more screenshots and give you some good visuals and get a little bit more into the mechanics and what's actually occurring. You know, we talked a lot about the concept today, but did it make sense to everybody? Any questions so far? All right, good stuff, guys. We're going to call it a session here for today. Tomorrow we'll get further into the 3 steps that are occurring in the order flow. And again, we're not looking to start looking for trades. We're lifting the hood here, guys, and we're looking underneath the hood and looking at the engine and trying to understand what's actually going on here. Yeah, we're gonna recognize the patterns and the conditions, but we have to understand. And now it'll start to make sense to you. You know what you're looking for, what's happening when you have divergence here. What's happening? Well, this was it. This was the pop. No more buying. Now you have the divergence. Yeah, V12 for sure. Good stuff. Thank you, Eric. We'll take it a step further tomorrow. Just think about what we went over today. I'll start the video process. The video upload process takes a few hours by the time it gets created and uploads in HD. So we'll get that posted on the site later on tonight for you. And we'll have our session tomorrow at 3:30. Thanks a lot, guys. Another great day. We'll get together again tomorrow and do it all over again.